Now that we know the differences between buying and selling options, let's look at when we want to buy an option versus when we would want to sell an option. When buying options, the primary reason would be to speculate, which means you are betting that the underlying will go up or down and would make money if it goes in your favor. Buying options provides you with the opportunity for higher potential gains while using a smaller initial capital outlay. As mentioned before, if the trade goes in your favor, the capital gains increase exponentially. So if you are right, you will start to make money, and the more correct you are, the more your gains will increase exponentially. This is a concept we will explain further in the intermediate section, but to provide some context, each option has a delta associated with it. This number will be between 0 to 1 for calls, and -1 and 0 for puts. The delta represents the change in the price of the option with a $1 move in the underlying. So the higher the delta is, the more each dollar move in the underlying impacts the option price. And similarly, the lower the delta is, the less each dollar move impacts the option price. If we look at this option chain, we can see that as we look further out of the money, the options cost cheaper. If we were to buy the 0.20 or 20 delta call option, it would only cost us $1. So we would need less capital to enter the position. However, we would need the underlying to move in our favor more to make money. But if it does, you can get more bang for your buck. When thinking of selling options, imagine yourself as an insurance company. Similar to how insurance companies sell people the right to cover certain expenses, you are selling someone the right but not the obligation to either buy or sell the stock to you. In both instances, the seller collects a premium from the buyer to make this agreement and does not owe the buyer anything unless something happens to the underlying. That could be a house or an FX future. To make this idea more concrete, we'll walk through an example of how an insurance company works and how you can take that idea and apply it to options trading. Let's say an insurance company sells 1-year home insurance to 100 people for $1,000 a home. After this transaction, the insurance company initially pockets $100,000. This is the initial premium. Over the course of the year, 20 people who purchased this contract filed a claim for an average of $4,000 per home. Those 20 people profit $3,000 on their insurance contract that they will then use to pay for their home. The remaining 80 people never had anything happen to their homes over the course of the year, and therefore, the insurance company keeps their premiums. At the end of the year, the insurance company walks away with $20,000 of profit. Look at the following table for a breakdown. We can see the transactions on the left, the inflow in the center column, and the outflow on the right column. The first transaction is the insurance company sells 100 contracts of insurance, each worth $1,000. This is a cash inflow of $100,000. The next is that 20 people file claims, average to $4,000 per person. This is a cash outflow of $80,000. The final amount for each the inflows and the outflows would be $100,000 in and $80,000 out, leaving the insurance company with a net profit of $20,000. One thing to note is how being a net buyer or net seller of options works over time for your profit. As an option buyer, you have the potential to take large, occasional profits on your trades in the short term. However, over time, you will likely incur financial losses and be facing a net loss across all your trades. On the flip side, as an option seller, you have the potential to take occasional large losses on your trades in the short term. However, over time, you will likely obtain financial profits and face a net profit across all your trades.